welcome to another live with Brent and Lee. It's been a couple of weeks since we've seen everybody because of hurricanes and travel and Thanksgiving, and hope everybody went into a food coma this weekend. So I know I did. How about you, Brent?
Oh, yeah. Went to the
All
Ohio
right,
State game, too. It was a lot of fun.
Yeah, that's right, man. Brent went to the Ohio State game with his son. So we've got a lot to share with you because there's a lot that happens in 2 weeks. So please leave your comments and questions, and also let us know where you're coming from. And welcome back to the show. Tonight we're going to go over what's going on with mortgages and what to be aware of purchasing new construction, but also when you're purchasing resales, and also different programs that you can look for. So we're going to break it all down for you. And then we're going to, at the end of the show here, we're going to talk about what's going on in the market a little bit also, because what's happening here in Florida and what's going on with the rest of the United States is a lot different. We've been looking at some numbers this week, and things are much different in the state of Florida than they are nationwide. And there's a lot of, articles going out right now and news on the television that might be freaking a lot of people out. And that's just, we're going to give you some context to some of these articles. So we're going to get started. So if you have any questions, bring your questions to us and let us know where you're coming from. So let's get going here, Brent.
All
right. So share our screen here. Let's get started here because this is the big news of the day. Dow rises 500 points in the final hour trading after Powell signals smaller rate hikes ahead. So stocks climbed. And the reason they climbed because he made this comment: it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring in inflation down. Moderating the pace of the rate increases may come as soon as December meeting, but Powell cautioned that the Fed may stay with restrictive policy for a long time before it ends its inflation fight. So I think the Fed is starting to see the destruction in the market because we're seeing job layoffs across the board now, not just tech companies, but I saw today Amazon is laying off. So that's a big deal. When Amazon starts laying off, it's a big deal. So we're seeing layoffs and across the board. We're also seeing the housing market is slowing down dramatically. One of my title agents says the worst she's seen in 30 years. So that's happening. But with that being said, this 2%, target that the inflation target that the Fed is trying to get to, I'll grow hair before that happens without without a supply side, and he can't do anything about that. So, your thoughts on this, Brent?
Well, it was a hairy day today. This morning, the ADP report came out, and the ADP estimates when what the jobs report is going to look like. Basically, they look at their own numbers, and ADP is a payroll service, and they anticipated 200,000 new jobs this last month, and it came in at 127,000 jobs. That was 8:15 this morning, and so that was like an indicator that the jobs market on Friday, which the Fed's talked a lot about, they're anticipating 200,000 new jobs as well. That's the estimate, and so if it falls short, that's gonna give the Fed some move to slow down the rate of increases up until this morning when that happened. Actually, everyone had baked in about a 0.75 increase on the 14th of December. Now that the futures look like more of a 0.5% increase, which is already baked into mortgage rates. That's so rates improve because they're only going to raise at 0.5 versus 0.75. So, you know, in those comments at 1:30 this afternoon, the market just took off because the assumption was that you know, that after he, you know, because he spoke, if you remember the last meeting, remember how hard
Right.
it was,
It was hard.
really hard about, hey, we're going to do this longer and harder than we thought we were going to, you know, and we're going to keep going till we get to that 2%. And right now, you know, this is a little advanced, but the 2-year treasury, you know, yields almost 3/4 higher than a 10-year treasury. And what that screams, the market saying, hey, what we think rates longer term are going to be lower because of a upcoming recession. That's what the bond market's screaming right now. And that's, you know, for an inverted yield curve, and to have it inverted that far is exceptional. And so the markets are basically telling the Fed, hey, you know, we think that's about all you can do. We need to start, tamping this down a little bit.
Right, right. So this could be a good thing for the future, but I wouldn't expect 3% rates
No,
ever.
no, that was a one-off COVID thing.
Right.
Yeah.
Because, you know, a lot of people don't realize that, you know, the 2008 crash, one of the catalysts of that was dropping rates into the 4s.
Right.
So, you know, and then we were in the 4s for 10 years, right?
Right.
So,
Exactly.
you know, if we could get back to the 4s would be great, but I think that's going to be a while too. So
We get into the 5s. I think this whole market's going to take off again.
I do too. I really do too.
Because a lot of it's recent memory, right? I mean, people remember rates were 7.25, 7.5, you know, a couple months ago, and you start talking 6s and then 5s, and people are like, comparatively speaking, even though that is extremely low historically, it's, you know, I think if people
well, I mean, you know, we talk about this all the time, but you know, rates were in the 8 to 12, you know, in the 80s. So
for years,
yeah, for years. So, you know, there's, you know, I think that, you know, we don't want to pull the market. I don't think we want to get rates back to a point where we feel the market so hot again that, you know, prices start going up. So we're going to talk a little bit about that, but let's get into our show and what we were going to talk about tonight, because this is important. Bait and switches from mortgage loans. You've seen this around for a long time. And when we talk about bait and switch, Brent, we're talking about, you know, mortgage companies and builders quoting rates, right?
Yeah.
And to get people to come to them, and then they run their credit, they get their paperwork in, and then when they lock it, it's something totally different. Now, I'm not saying that's the case all the time, but talk about a little bit of this. What do you say about the bait and switch in the mortgage loans?
You know, we see it all the time. Unless you know someone's specific income, the history of the income, if it's stable, the credit score, any extenuating credit circumstances that might be out there, like a repossessed car in the last 2 or 3 years, that type of thing. Until you know all of it, you know, really, in the down payment that's available and it's been seasoned for 60 days, there's so much that needs to be taken into account before you can actually quote a rate. So I say it's irresponsible, really, to quote a rate someone over the phone in 30 seconds, that type of thing. And but we do see it all the time. We see where they're quoting rates, and if I see it on TV all the time. And if you ever notice, there's this qualifiers, and it's very difficult to see at the bottom, that fine print.
Right.
If you look really close, the FICO has to be, extremely high. It's basically a qualifier. This rate could change, all that stuff. And so it's unfortunate, but a lot of times it gets the phone calls, and then they switch. Some of the internet lead providers, people purchase those leads, or lenders purchase those leads from like aggregator that just generates the leads, and they post these rates that don't exist. It's really amazing that still exists, but it does happen. And then they find out the real deal, and they're called by 10 people.
Right.
So,
and we're starting to see this happen, and we're going to see more and more of it, because the refi business is so low, and mortgage companies are really fighting over clients right now. So before a rate is quoted, what kind of paperwork do you need? What do you need to know?
Yeah, for a self-employed person, it's a little different than a salary type person, but a typical salary job type person, we're looking for the last 2 years W-2s, the most recent pay stub that pretty much covers the income. Oftentimes, we'll need the entire tax return if there's some things on the tax return that we need to see, but generally speaking, the W-2s will suffice, and the year-to-date pay stub. And the last 2 months bank statements showing the assets available for the down payment, where the cash is for the down payment, if any, and then the driver's license. And if it's a refi, then we'd need the tax information on the home, the homeowner's insurance, that type of thing. And that gives us a really good idea of where we're going to be. And a phone call is really important, because you really need to have, there's about 10 questions we need to ask. Who's going to be on title, and are there co-signers, or is the down payment coming from someone else? Is there a gift? All those types of things. And is there any potential title issues that are general liens that could be drawn over to the property? In other words, a business bankruptcy in the past or something like that might be an attachment that would follow you. So those types of things we need to clarify. So a phone call is really the best way to get it, but that's what we generally need as far as documents.
Okay. So let's look at this. These are some of the programs that are being offered right now by the new home builders. And, I'm not picking on anybody. And also I want you to know that, I'm not saying that this isn't, factual if you qualify, but that's the thing. You have to qualify for this stuff. And it's really important, because I know that, a few builders, Mattamy being one, they'll do a soft pull when you apply online. So they want you to apply online. They do a soft pull, and then if you qualify, they move forward on the soft pull. But some of these builders, do hard pulls, and so when they pull your credit and they do a hard pull on your credit, it's totally different than a soft pull. And explain the difference in that, Brent.
Yeah,
that's something people need to really understand, especially new home buyers.
Yes, years ago when the FICO program started, where they objectify the putting a score, a numerical score on your credit. It used to be A, B, C, D. They used to grade it like in school. You know what I mean? And you just knew that if there were so many lates on a mortgage, that type of thing, and there was a way to do that, but it took a good deal of time, frankly, and you had to really know how to do it. It required a lot of experience. Now, they can really dial it into a number and using the middle score. And so when you do an inquiry like this, it used to be a set amount initially. Hey, if you pulled your FICO, 4 times in the last month, your score went down, 22 points, type of thing.
Right.
And now, excuse me, now what they do is they bracket them. And so if they know you're shopping for, let's say, a mortgage pull, and you've done it 3 times in 2 weeks, they know you're shopping, so that won't hurt you that way at all. It'll be just like one pull. And so that's what.
So shopping for a mortgage is different than shopping for a car.
Exactly.
Right. So if say that they do end up doing a hard pull on you, and it's not what it's supposed to be, and they want to go look at another mortgage company, then when that mortgage broker pulls or our lender pulls the credit, it's not going to affect their FICO.
No, it won't. It won't affect them at all. Now, and especially if they do a soft pull is not counted as inquiry at all.
Right.
And so, so that's one way to limit that. You need to do a hard pull at some point in time to get the 3 scores and to dial in what you can do. But when you're shopping for a mortgage,
and again, there's no way to quote a rate until you have that hard pull.
That's exactly right.
Okay.
That's exactly right. I tell this story. One time I had a guy say, I have perfect credit. Don't worry about it. You don't need to pull my credit. We pulled his credit 2 weeks into it, and it showed as a bankruptcy, like literally 2 weeks prior. And I said, hey, you know what? I don't want to freak you out or anything. Well, this can be a mistake. I confirmed the Social Security number, all that. And I said, there's a bankruptcy showing on your credit report. And she goes, oh, that's me, And so right. I said, yeah. I said, well, you said your credit was perfect. He goes, yeah, I talked to my attorney. I don't need to pay any of that stuff anymore. So,
Right. So
you
they
know,
just understand. Right.
yeah,
Yeah.
just didn't understand. And so a lot of times, so it records the history. And so the history remains. And sometimes when you negotiate things, we can help people with this all the time. We do it all the time. Like medical collections, that type of thing. They're removing those, you know what I mean? As soon as they're paid, they're actually deleting them immediately, as opposed to just showing the record. So there's a lot of little things that have changed recently. So going through it line by line and really just doing what you can to get that FICO score up. If I have 60 days, I love it, because there's a lot of things we can do very quickly to improve someone's score.
Right. And especially now, I mean, when rates are where they are, you know.
Oh,
And then
$7,000-$8,000 difference.
right. And with these new home builders, one of the things that that I'm finding right now is there's multiple they have multiple lenders now, and they're offering all kinds of programs and locks and things like that. And you just really need to read the fine print and understand and ask all the questions. And that's where a good agent comes in. But also knowing that, look, there's multiple lenders. So instead of maybe using the main lender that's the builder's lender, you might want to ask, hey, like, what other lenders do you have? What other programs are offered, right? Just like you would do if we're buying a resale. You're gonna look at the client and then look at all the different programs and offer them multiple options that you can find that works best for them.
Right. That's absolutely correct, Lee. And, just, to mention, like, in the new construction, we locked, 4-6 months out, early this year, and saved tens of thousands of dollars for your clients.
Right.
And then, then the reverse happened when rates started to go up, because the builders wouldn't lock until they were 30 days out. You remember that?
Right.
So sometimes builders have a requirement, they won't lock, and hey, rates are going up, they're racing up. And so we're able to get a lot of people locked at great times, and they're a great spot now. But the reverse is true. We were working with several of your clients before, and this last several months, where it actually made sense to float, you know what I mean, as those rates were beginning to improve over the last couple months.
Right.
And so, it keeps them honest, just to have, some other option that you can keep an eye on someone, to be honest
Right.
with you.
Yeah. Because you don't want to lock in at 7% and then, the house is ready in 9 months and rates are at, in the low sixes or high fives.
Right.
Which could absolutely happen. I mean, we don't have a crystal ball, but, this is positive news that we got today from the Fed. And, especially with, credit card debt going up and household debt moving up, and they just can't crush the entire market, because we'll have recession isn't the word for it. You know what I mean?
Oh, yeah.
And Powell doesn't want to be responsible for that. I'm assured of it. So,
well, there's another survey that came out today. Chicago Purchase Managers Index came out today, and it was estimated to be in the 40s and came in the mid 30s. And basically anything over a 50, it means a purchasing manager seeing an uptick in the economy. Things are booming. Anything below 50 is on the on decline or contracting economy. And so that's a big number to come out, and they come in at like 37. That's a stinker. That's a bad report. And so those recession type leaning figures are coming out, and I think the ADP is a precursor to what we're going to see on the jobs report on Friday. And I think that paired up with Jerome Powell's comments this afternoon at 1:30 really got the markets going, because they're anticipating a slowdown in those hikes.
Right. And as the stock market moves up, rates move down.
Right. Yeah, that's what happened today.
So, this news was already out. Rates have fallen now, for a few weeks. So, where are we sitting right now?
Yeah, you're in the mid sixes now. We just locked one up at 6.25 on a VA. We were like talking about it today, and so I don't know if we locked it today. We're going back and forth on it. We've got two really big reports coming out the remaining part of this week. The personal consumption expenditures report's coming out tomorrow, and that's the Fed's favorite inflation figure to figure what, as far as determining rate hikes, even above CPI. And that's coming out tomorrow. The estimates coming in, they're thinking month over month, or the estimate's 0.3%. So you multiply by 12, that's at 3.6% inflation. So when they're talking 2% inflation, by the way, it's really, a lot of people think it's CPI, but PCs are favorite. So that's really what they're looking at. And the 5.2 is what the estimate is for the year over year. So they're anticipating a lower month over month, to get, so the increases are decelerating. In other words, inflation is definitely coming down, because the year over year is 5.2%. But if we miss that mark and it comes in, less, then, we're off to the races. I think
Right.
then the ISM index is coming out that tomorrow too. A lot of big reports, and Friday's jobs report's huge because the Fed's wanting to see pain in the labor market, and so
Right.
I don't really get that. I don't think everyone has,
I don't either.
but
It doesn't. Because that just costs the government more money because now they've got unemployment situations. So
right.
I mean, it's just a really, but here we go. Bars are back. Mortgage applications are on the rise at 2.2%. So, we're seeing more buyers in the market. We're getting calls. We've got we're getting calls this week, last week. I know that the new home builders are picking up right now. They're seeing more traffic. So a lot of new first-time buyers coming in the market. And that's really why I wanted to do this tonight and talk to, folks, because, it's important that first-time buyers really know. And that's a lot of the calls we're getting right now is from first-time buyers, wanting us to help them walk through the process of getting into their new home, which is super exciting for them. But there's a lot of pitfalls out there right now that they can run into, and one of them is, these lenders. So, it's asking all the questions, getting all the I's dotted and T's crossed is a big deal.
Yeah. Yeah. Getting prepared for a mortgage is really important. Just, getting all your documentation together and really, because the best rate's going to go to the best way we can show the income, the most stable way we can show it, the most, the dialed in credit report that's basically, all duplicates are removed, all that type of thing. There are no errors on it. And also, paying down, we do the what ifs. I think we've talked about that before. What if scenarios where we can, hey, if we pay this credit card down $25 or $300 or whatever it is, and just keep running an infinite number of options to get to the best score. We offer that as a free service to help our borrowers get in the best spot.
Yeah. And then, let's talk a little bit about this because, there's a lot of programs out there coming out, and we feel like there'll be more coming out as rates stay high. There's the 2-1 buy down, there's the 3-1 buy down, there's ARMs out there right now, which aren't as good as the buy downs are. But, with being able to get seller credit, like I was talking to one of our agents that just came on with us, her. The other day, she was working with her client, and one of the things in tradition is that if you're not buying a Mattamy home, you're buying a reseller or buying from another builder. There's a 52 if you're in the HOA, which Riverland is not, which is GL. But if you're in the HOA, they have a $5,200 beautification fee that's in there. It's a one-time fee, and so that's something that you got to be aware of. And they've started doing that with resales now. So they're taking it on any home that's sold in tradition now. So that's a good place to go back to the seller and say, hey, we need a credit, right, at the table to pay that, because that's cash out of your pocket immediately, as well as these buy downs. So there's negotiating power right now. Also there's these assumable mortgages. So, I don't really do USDA. I know if you're in that market, but FHA and VA, there's ways of assuming these mortgages. Talk a little bit about that.
Yeah. FHA and VA and USDA in the late 80s, there were up until that time, they're actually blind assumables. If you had a pulse, you could actually assume someone's mortgage and start, pay the difference. If you got to look at the balance. There's some hoops to jump through. You have to qualify now. In other words, not blind mortgages anymore. In other words, blind assumptions. So you have to qualify for the loan. And then you have to make sure that, the seller's liability is, released. So we need to get that from the lender, some things like that, the existing lender. And it's a full qualifying process you have to go through. But it is, with interest rates so low, a couple of years ago, there are some deals out there. You do have to make up the difference. They won't lend you above and beyond the balance. In other words, if you bought a $400,000 home and has a $300,000 VA loan on it, you're going to need to qualify for it. And you're also going to need to, put $100,000 down. That's the drawback, the benefit of VA. A lot of folks, the number one perk is zero down, type of thing.
Right.
So no down payment. So yeah, but in FHA, the same case there. They're not blind assumable loans anymore, but you can qualify for that if you find someone that has an FHA loan, and you can make up the difference on that down payment, get a release from the current lender. They have to release it, the liability from the existing seller, the existing borrower, which is the seller. But it is possible.
So, question here: why is bad unemployment news good for the market? It's not usually, but what the Fed's trying to do is unemploy people so they don't have any money, so that they can't buy anything, so that they brings inflation down. It's a band-aid. So it doesn't make any sense. But it's, the Fed only has so many tools. So one of the tools is unemployment. They can get unemployment higher, and then there's less money in the market, and then inflation comes down. But
they lower rates.
But
they'll lower rates. So it's kind of a domino effect, right?
Right.
I mean, so if there's bad employment, you want good employment. So solid employment drives the market up. Actually, if everyone's working, that's a good thing. However, if it heats up too much and you have inflation like we do now, the Fed's looking for that bad news where hey, when do we want to stop raising rates and start lowering them? And the reaction we saw today with Fed Powell speaking, hey, we're going to slow down these rate hikes and improve both bonds and stocks, which is, a little out of the ordinary. So it's, so lowering rates will improve the market. People are entering back into the housing market. That's a great question, Costas. It's a very good question.
It just doesn't, it's a,
it's a balancing act.
Yeah. And but unemploying people to me is, I mean, are you kidding me? I mean, it's just, we don't want unemployed people, people need jobs and they need to work. And so this is the worst thing I think that's coming out of the Fed right now, is trying to, and when he spoke the last time, he was saying, I want to take out some of the jobs that are, that are right now that are not being filled. But what we're seeing now is the market's slowing down, and when Amazon starts laying people off, that means they're delivering less goods, and that means that there's less money in the market right now. So I don't know.
Less demand for oil. I mean, brings prices down. So it's a balancing act.
Well, and that's nationwide. So you look at the price of oil, it dropped to 79. It was back up to 80 today, but that's worldwide. So we're seeing a worldwide slowdown in people using oil. So
absolutely.
And that means, that because we're of a global economy. So I don't know.
Costas, we have a five. It's a 50 basis.
Take me out and beat me with a stick for trying to have a job.
Right.
You know what I mean? I mean, we're getting punished for wanting to work.
Right.
Right. I mean, that's really what it is.
Yeah.
And it just makes no sense to me. So, I mean, I don't know how long that's in my opinion, that's a band-aid, because as soon as the economy starts coming back again, we're going to see jobs, and people having jobs is a good thing for people because it makes them happy.
Right. Productive.
Should the Fed lower the rates? No, we don't want to ever see that.
Yeah.
So
the Fed should lower the rate hikes 3.78. Yeah. So that's what they've done so far this year.
What they've done so far. Yeah. This year.
Yeah.
Yeah.
Yeah. They've got to slow down.
They got to slow down. Yeah.
Yeah. And they will. I think that it's pretty much baked in that, what the Fed said today. I mean, he's talking out of both sides of his mouth, because really the only report that's significant is the ADP report that came out this morning, but that those comments were planned before that release. So,
right.
I don't know. I think that they're seeing things.
There's pressure coming from other places.
Yes, I think so too.
Yeah. I think there's pressure coming from other places. So, I mean, they say the Fed's not political, but there's no way it can't be.
Right.
So anyways, so let's talk about this. So we're going to switch gears a little bit. If you have any more questions on mortgages, go ahead and hit us up. We're going to switch gears a little bit, talk about some of this news coming out that's meant to get you to go online and listen to them because, you know, bad news sells. That's all there is to it. So, but we're seeing articles like this. Fannie's forecast rough in 2023, better in 2024, right? So the full impact of high mortgage rates has yet not, but in 2024, it should be better after a slowdown year. Here's my thing on this, Brent. It's like I had a rocket ship, right? And it was going at Mach 10, right?
Mm-hmm.
And I've slowed down to Mach 1.
Right.
Right? Because you just can't sustain what we were going through for the last 2 years. And all of these forecasts and articles that are coming out are comparing the last couple of years to what we are now.
Mm-hmm.
And so there's, you know, a lot of these articles are scaring people that, oh my gosh, the end of the world's coming and the housing market's going to collapse and we're going to see thousands of foreclosures and 2008's back and, you know, you're going to pay 10% interest rates and all of this stuff. And better than what? You know what I mean?
Right.
I mean, the last 2 years, if you were VA or FHA or a first-time home buyer, you probably could not. I mean, it was a challenge to get you a home. Right. It was not a good market. You had tons of cash coming in. You had mortgage rates to a point where, you know, 80% of America homeowners right now are sitting at 3% or under. And that's a problem for buyers in inventory in the market right now because they're just not going to sell. We took a house off the market again today. So because I don't believe my client should sell his house for less money than it's worth. So we pulled it off. So I don't really, these articles I don't think really, you know, grasp the reality of the situation we're in.
Right.
And
I agree.
Right. And so, like, here's another one. Homeowners have lost 1.5 trillion in equity since May, right? Home prices drop. This was CNBC. This came from Black Knight, all right? So they've lost 1.5 trillion in equity since May. So again, scare article, right? World's coming to an end, right? Equity's going out of your home. You're losing everything. This is perspective, right? So this is where we're sitting right now at 10.3 trillion. In 2021, we were at 9.9 trillion. 2022, 2021, right?
Second quarter, yeah.
But if you go back to 2019, I mean, this is where we were sitting. And this was a healthy market in 2019.
Right.
Right?
Right.
So we're sitting at about what? 40%? Right? So if equity dropped 40%, you would still be at 2019 numbers.
Yeah.
Right? So that's what it would take for the housing market to get back to 2019 prices. 40% drop, right? Not happening.
Yeah.
Right? You got a better chance of catching a ride in the space shuttle than that happening, right? I mean, I'm serious. Right. So it's just not going to happen. So if the market drops 20% because of rates, right? You still have 80% of Americans out there with plenty of equity in their home. So if they lost their job and they needed to dump their home, they would still be able to sell it and walk away with money.
Right. Yeah, if you extrapolate the trend there, from what 2010 on through, you're going to see, you know what I mean? It's pretty
Right.
much a straight line with the exception of the COVID. I mean, you can see what happened there.
Exactly.
And you can see what
Exactly.
happened, the financial crisis before too, and so 07, 08, 09. I mean, that was all just a bunch of bad mortgages. So there's reasons for this stuff, But I
Right.
think, like you're rightly, I think if we go back to 2019, that was a normal market. Just kind of
It
have to
was
look at that.
it was a normal market, and you can see the trend
Yeah,
from 2012, right,
yeah,
all the way up to 2019. That
yeah,
this is nationwide.
right.
Florida's way more than this,
Way higher, right?
way higher, right?
Yep.
So here's another one. Household debt soars at fastest pace in 15 years as credit card usage soars, Fed reports today. Again, another article, read between the lines, go do the research, because here we are. Credit card balances are just near 2019 again, right?
Mm-hmm.
So the debt has gone up dramatically because the way the Fed has moved on rates so fast. But
Mm-hmm.
and then we're in this recession where food prices are higher, everything's higher, but we're seeing things like cars dropping 50%.
Right.
Right. So again, when you're reading these articles and you're looking at what's happening, it's always good to go back and really look at the numbers, because the 2019 numbers, just like inventory right now, we are way off the 2019 inventory numbers. Way off. We're really still low on inventory. So again, and here we go. Housing prices, because we're sitting here talking about all this, right? And then this thing comes out. Like, this is the 29th, right? This is yesterday. Housing prices up year by year, down by month, right? So CoreLogic and Case Shiller says that year over year is an increase of 10.4%, but Miami is 24.6% and Tampa 23.8%, leading the nation. So again, getting back to Florida, but nationwide 10.4%. And then we
Right.
come to Florida and we're seeing housing prices still way up, right?
Yeah.
So
Right.
again, going back to, the market could lose 10% and 20% in certain areas, and still people would still be in great shape.
Right.
But what's happening is 80% of homeowners sitting at 3% or below in their mortgage rates, they're not selling. They're not giving their home away. They're just not, which is reducing inventory dramatically. And we're running into the worst selling season ever, which is December and January, which is the slowdown. December, January, February usually slows down across the board. But in Florida, we're seeing the market still moving right now.
Mm-hmm. We're seeing people pull equity out of their home to purchase investment property.
Yeah, refis are up right now.
Yeah.
Yeah, talk about that.
Yeah, I mean, they're going to just recently what happened with the recent rate drops, and people are coming back in because they're looking like, hey, we think that there are going to be some bargains, there's going to be more homes available, that type of thing, and they're getting in a position to get, dry their powder and be ready to buy, and so different folks have different opinions on the market, and obviously, but we see right now, I think certainly, as rates dropped here, from 2 months ago, we're down, almost 75 basis points. And so that's a big difference. It's a big difference.
Right. And since we're on Florida, let's just finish this out, right? Let's see here. These stinking bots, man.
I know, right?
All right. Anyway, so here we go. So let's show this slide. What about this? This came out yesterday too. So if you live in Florida, you're a happy camper right now, I guess. I mean, Florida,
fucking a national trend.
I know things are bad. I know the market's bad, but I mean, when a survey comes out like this, I mean, really, dude, and and over Thanksgiving, what an awesome job. So many, the food banks here in Florida, the churches, all these organizations. I mean, the amount of food that was given away over Thanksgiving was just extraordinary in Florida. I kept reading articles about, the food bank here in West Palm Beach and Riviera Beach was just loaded, and they were literally giving people a week's worth of food,
Wow.
So, so there's people suffering in this right now because of, obviously incomes are not reaching what inflation is reaching right now for a lot of people. And so they're struggling, but in this, at least we're seeing, here in Florida, people trying to help people. And I know it's not perfect, but they're trying, right?
No place is perfect.
But here you come out. Florida consumers grow more optimistic in November. Bucking a national trend, Sunshine State consumers express more positive attitudes about their current conditions and the future, both short and long term.
Yeah, no, right. I was out, like I said, I went to the Ohio State Michigan game, which is an incredible thing to go to. But we met people from all over the country that flew in for the game, and you say you're from Florida, there was a very positive response. You know what I mean? Gosh,
Right.
what's it like? And we've thought about moving there too. I've met some folks from California in a restaurant, and we just had a great conversation about real specifics. And they're like, "Well, we're looking," so. Yeah.
Right.
So, just the overall impression people have is, it's a wonderful place to live, for a lot of reasons,
Yeah. And then we go to this article. Florida has 5 of the top 10 states. This came out today. All right. So Florida has 5 of the top 10 move to metros in the U.S. So Miami, Tampa, Cape Coral, Northport, Sarasota, and Orlando. So obviously people don't even care about hurricanes. They're just going to move here anyways.
Right.
Because we just got, the West Coast just got hammered,
right.
And then we just got this freaking hurricane run across a couple of weeks ago. And we're still people are still just moving here like crazy. So,
yeah. My wife's chiming in again. You must have a rad wife, Brent.
Oh yeah,
Buckeye game.
If she sent you to the Buckeye game,
it's a lifelong dream. Oh, it was wonderful. Even the Buckeyes lost.
Show your cup. Show
What's
your
that?
cup. Your cup.
Oh,
your cup.
yeah.
Your cup. Here you go.
Can you see it?
Yeah, my wife is hotter than my coffee. That's there you go. That's true for both of us.
That's true. We married well. It's important.
Right? You're red and I'm bald, so I don't know how that happened. So. Anyways, so again, so let's talk about why people should buy right now. Because if you're looking to move to Florida, your first time buyer, I think now's the time to get things going and get in the market, because if rates do come down to 5%, there's a lot of people sitting on the sidelines right now waiting on that. And it's going to be like we said before, stamp it on an ant pile. It's just people are going to come out and buy. And if it's still low inventory, it's going to get harder and harder. So right now, yes, rates are higher, but these are reasons why you should be interested in getting into market, especially if you're a VA or FHA, or you're looking for that perfect house in a place where before it would be really hard for you to get in there, because prices are coming down. And there's a lot of negotiating power for homes sitting on the market. And the reason that is because the sales that are out right now are mostly forced sales, meaning that, somebody passed away, somebody's going into a retirement home, they're moving because of a job, whatever the case may be, but they're having to sell their home. If they don't have to sell, most people are not selling. So they're forced sales. And right now, the rising interest rates make the homes less money. So, the interest rate, the home you marry, right? The interest rate you date.
That's right.
Right. So, you can always go refi, but you're not going to be able to buy that house for less money. So and I think, in the next couple of years, you're going to be able to get the rate down. And with the 2-1 buy down and with rates coming down, you're probably going to be in a 5% rate, right, Brent?
That's what I'm thinking too. Yeah, the 3-2-1 or 2-1 buy down's a great option
Yeah.
where the seller has a credit towards that rate for the first 2 or 3 years, and it makes a big difference. And then by that time, I think the market's definitely going to turn. It's already starting to. I mean, it's all clearly started to. So I think that will just continue offer an opportunity to refinance. Absolutely.
And besides being good looking and having great arms, who's the best agent on getting seller credit?
Oh, that'd be Lee Bricky every time. Man, I'll tell you what, 2 years ago, we just knocking them out every deal, 7, 8, 9, 10 grand. It was crazy. It was crazy.
Almost every deal, right?
Every deal. Every deal.
Just,
Remember, we had someone actually got a check at closing. That's
right.
never happened.
We got
before.
a $15,000 credit here in Jupiter, man. It's like a house in Jupiter.
Yeah.
So we have more negotiating power. You can if you can find an agent that can, it's not afraid to go into the fight for you. That's when you're going to be able to really negotiate down. And in all honesty, if seller credits are much easier and negotiating right now. We just closed on a home. It was listed at $1 million. We closed on it at 845. So, so it's a good time right now to get out there and try to find a home. And, if you can't find that perfect house, that's okay. Especially if you're a first time buyer, find something that fits your family. Because you're going to be, 3 to 5 years from now, you're going to be able to sell it and move up to something different or move into something different. So it's just a great time to get into the market, I think. And there's going to be some opportunities for investors too, because we're putting that game plan together. You and I are, but it's been a long time since we've been able to, go and flip a house. So I think you're going to see a lot of that opportunity too for investors who want to do flips. What we're seeing right now from our clients, they don't want to do any fixing up homes. They don't want to do any repairs. They just want to move in and buy the house. So, and ready. So, being able to go in, buy a house and repair, do some repairs to it, rehab it and put it back on the market. I think those days are coming back.
Yeah, I think so too. Yeah.
Oh, all right. So that's all I got.
Good stuff.
Yeah. So look, I mean, if you have any questions and your comments, leave them in the comment section below. If you're seeing this video after we did it live, we always get back to you and answer your questions. Don't forget, Brent and I are both in the real estate business full time. So if you're looking for a home anywhere in Florida, reach out to Brent. Don't forget to go to his YouTube site. Brent starts at Unitas Lending. He's got his own site. There's a lot of good information there on mortgages and how to get your mortgage and learning what's going on a daily basis, weekly basis with all this news coming at us so fast. We'll be back here next Wednesday. Also, if you have not subscribed, hit that subscribe button, ring that notification bell so you don't miss any of our real estate tips and tours. I'm going to start pouring on some content here. So we're going to really do a lot more content, a lot of areas, and showing off a lot of great places for people to live. So you definitely want to subscribe to this channel. And we appreciate all of you coming on and watching, and hope everybody had a great Thanksgiving. And we're looking forward to awesome holidays coming up. So we'll be back next Wednesday. Be kind to each other, and we will see you next week.
See ya.